let's look at how things have worked out in the past and see if that can lead us into our decision making going into the future.
Lovely.
So this is something people like to ask about, which is when they start trading a lot of zero DTEs, they wonder, well, what if I put the trade on like the afternoon before? Right? What does the 1 DTE look like? If you just want to get a little bit more premium in it, a little bit of duration, still have that really quick, snappy, fast returns, super liquid market, kind of lower capital requirements, tighter strikes for similar deltas, but not be literally day of. What happens if we start, looking at what if we sell some premium at market close, or 10 minutes before market close the day before, and see the results of those if what comes up in the morning.
The dreaded overnight theta decay question.
Yeah. Dreaded. It's truly a joy. It exemplifies what I like, which is to set up some theta decay and then go have a sandwich or take a nap, or and then come back to it. So this is what today's study is going to be. Just to set it up, right? Zero DTE sort of throws out a lot of what we built. We built a lot of research around the advantages of duration and giving yourself time to be right. And that's not there at all when you trade zero DTEs. That just isn't what they are. There's no time to be right. So we're just gonna try to find put a little bit of that back into the system. And so let's take a look at the details of the study. So we're going to look at the 3 months of data, because that's what we have when we're looking at 10-minute resolutions. We're building it every day. Every day the data set gets bigger. But for now, we got 3 months. And it winds up being, I'm trimming it a little bit more because I'm not going to think about selling on a Friday afternoon and looking at it on Monday morning. It's only going to be, an actual just one overnight.
Like a Monday going into Tuesday, or a Tuesday going into Wednesday.
Exactly. And actually, I'm not even cutting. I think there's a half day in the data set that I didn't want to consider either.
Okay.
These are all. Oh wait, let's stick on the slide sheet for a second. Thank you. So what we're going to do is we're going to consider sort of 3 ironflies or butterflies, or whatever. It's a short premium trade. We're selling straddles and buying strangles, right? And we're going to do it $30, $40, and $50 wide in the SPX. That's because Tom and Tony love trading the $30 wides on the zero DTEs, but because there's an overnight move, you really I want to see maybe the strike should be a little bit wider out, and that's what the data is going to bear. And we'll look at just what happened overnight, and then also just if you left that position on all the way through expiration, what would happen to you? What are your situations like? Why don't we do this?
Yeah.
So let's take a look at the numbers. So here we are. If we're going to close them just straight up, first thing in the morning, we get up, we don't even look at it, we close it. I mean, listen, if the thing hasn't moved and these are still good strikes and you want to be in this new position, you don't have to close it and reopen it. Like you don't have to have the slippage effect. But for the sake of data and analysis, this is what happened overnight. So this is if you were to close in the morning, and you see that the 30 delta wings, right, are you're collecting $21 in credit. So this is like a really aggressive trade, right? It's a $30 wide wing and you're collecting $20 in credit.
Yeah, it's a 25% pop if you were, or like 30% pop if you were looking at this on the
right. But actually, 50% of them were winners when you manage the next morning.
Yeah.
Right, which is you get a little bit higher pop by managing them early, and the conditionality risks aren't bad, but the wider wings really do perform better, right? You get more conditionality risk, but you also get more average P&L, you get better credits, you get better win percentage. I think this is a pretty good case for this. It seemed like a pretty good winning trade over the past couple of months. Of course, right, we have to keep in mind this is only the past several months. It's been very sideways past several months. We haven't had any huge swings either way, but these are also defined risk trades. So, right, 1 or 2 huge swings one other way isn't going to screw you too badly. But I mean, right, you can see in the C-bar that they didn't. You weren't getting 5% of the time a $30 move overnight. It wasn't happening at all. Which is nice.
We've also had contracting volatility too over the last couple months, so that's also helped with what has been a chop fest, as you mentioned. So it's definitely been a good period of time for this sort of trade.
Yeah, right. So there's some rose-tinted glasses because of the specifics of the time period that this looks at. Don't overread into them, but it's certainly promising. And in particular, I want to contrast it with if you left those positions on throughout the whole next day, right, till expiration. That's the next slide, and it's a little gruesome, I think. Right, they're still net profitable. Right, the average P&Ls, just overall the trades, is you're still up money, even if you've done this whole time. But your win percentages are bad, and in particular, the condition bound risks are bad. There are some big losers in there. Right, it's not that many. It's few enough that you're still net making money over time. But the condition risk is, I mean, that's more than I personally am happy bearing on a singular trade.
Yeah. And I think the big difference here is holding to expiration throughout the day, especially with the VIX being so low, the expected move in the SPX for one day being so low, and then something happens and you see the market shift aggressively where there's been 30, 40, 50, 60 point moves in a day, but the expected move was certainly only 20 points or 30 points. So that's where you're getting these big losers from, as opposed to just trading the implication that there might be some movement from overnight to the morning, and if there's not, you're going to get some cheddar out of that spread.
Yeah,
and the other thing is we've done a number of studies in the past, sort of that just overnight moves are not. The market moves more during when it's open than it does when it's closed, sort of on a per time basis. So that's like a nice way to get your overnight data.
Yeah. And I'm looking at this in just the win percentage as well, kind of is sticks out to me based on managing early, which you expect to have a better win rate when you're closing trades early. That's just intuitive. You're taking winners quicker, and you're taking that potential tail risk, as outlined in this segment, off the table going into, or on this side, into the end of the day. But I think here it kind of outlines the reality of these 0-day trades, is that if your your tail risk is pretty much the full risk on the position when you're opening the trade, right? So if you're putting, you're going $40 wings or $50 wings, you should expect your losses and your 2 standard deviation kind of occurrences to be full losses. Like you're probably not hitting small variable losses. They're probably all, big losses, because you only have 1 day's worth of time. There's no management. You can't roll it. It expires in hours or minutes and not days, etc.
Yeah, these are defined risk trades. I think like earlier in the 0DT segment, I did a study where it was like put them on at 9 a.m., manage at noon to try to get the mimic the behavior of a 45 DTE managed 21, and it didn't really work at all.
Yeah.
But this sort of gets a similar effect, like putting on the 1 DTEs and then just managing them in the morning and not carrying them through the 0 DTE does have a very similar effect on win rates and P&Ls and condition bounded risks as sort of your 45-day, 21-day management styles. So I think that's a nice way to get people who, have a lot of comfort trading, sort of in our classical mechanics, our 45 DTEs, manage 21, be very mechanical that way, and they want to get their toes wet in 0 DTE. I think this is a nice way to start at 1, manage in the morning, and see how those feel to you. It's much more in parallel with that.
Yeah, capital intensive too, right? Because you're putting up a couple grand on each of these. So it is a capital intensive trade. That's another point to make, is that you're not doing this sort of trade in a $5,000 account because the tail risk is just too great. You have nothing you can do with it. But if you're in a larger size account, it might be an interesting trade to put a couple of these on every once in a while as sort of just a added position to what is normally a 30 or 40 day time frame for your trades.
And the other issue is if your account's small enough, right? If you're putting on 0 DTEs and trying to manage them, that'll run into pattern day trading rules.
That too, yes.
Which can gum up a small account and mean that you're not actually allowed to manage them as much as our data says you would like to.
Yes.
But if you have the capital and you want that quick return, that nice instant gratification, it's there.
Yeah. And it's been working the last couple months.
Yeah, I mean, right. It has been working, and if you're defined risk, then eventually it will stop working. But if you're defined risk, you won't be burned that badly when it stops working.
Yeah.
Which I think is a nice premise. So that's our data for this morning. So to let people know that I think the overnight 1 to 0 DTE gives us sort of a nice parallel to sort of the 45-21 DTE. I've been trying to figure out how to make that work, because sort of in the absolute theory of it all, everything just should scale down, right? You should just be able to contract. I should just be able to like scale the time variable and the price variables and make everything work the same. And it wasn't for a while, and this finally made it behave similarly, which was nice. But you don't want to be treating it as set and forget it, right? You're putting on a trade the day before and then letting it just run through the whole day of its expiration was a very high risk maneuver. And the other thing is that, right, you were mentioning that it's been low vol, but even within that, there's been some range in volatility. But that range has had very little correlation to how much the actual absolute size of the overnight moves, right? The expected move can be whatever, but you still sometimes get 0, sometimes you get double, and it's only like 0.5 correlated between the magnitude of overnight moves and the VIX and the closing VIX from the day before. So I don't think that you really want to just view volatility as how much premium you're getting. So like higher volatility makes these trades more appealing, not less.
Yeah,
because they're less expensive.
Yeah, exactly.
Yeah.
And what's nice about these trades is that if you're right and the market opens kind of flat, you can take your win and close the trade. But if you're wrong and there's a big move pre-market, you still have the entire day of extrinsic value and implied volatility in that spread. So it's going to help you not be at max loss. Even if it opens right at your long strike, you still have plenty of premium in that long strike to prevent you from realizing max loss. Where if you started in the day and you held it till noon or 1 o'clock, you're going to be much closer to max loss than being able to get out of it in the morning or see what happens over the next couple of hours, that kind of thing.
Yeah. And by less expensive, I mean that higher volatility will mean that iron fly, instead of trading for $20, is going to trade for $25. So you have less risk. If you get that inside move, you have more potential reward because of that inflated premium. It's less expensive to buy it back the next day.
Yeah, right. Mike was saying exactly the same thing that we say when we talk about why it's good to manage a 45-day trade at 21 days, right? Because you still have that extrinsic in there, and that's why the condition of added risk, right? On the held through expiration, it was pretty much full losers was the condition of added risk, but on the managed in the morning, it was actually like it was it was much more reasonable numbers.
Yep.
The sort of risk that an account that isn't huge but is big enough to be doing 0 DTEs, I feel like should be willing to accept if it's a good trade and appealing. But keep in mind, if you've gotten used to 0 DTEs and you're going to trade them the day before, if you pick your strikes by delta, you're good. That's already scaling for you. But if you don't pick your strikes by delta, if you pick your strikes by raw number, you're going to want to wind them out a bit. And then the other thing is, you're going to want to check on them in the morning. Don't just set it and think to yourself, well, good trade, I'll see you tomorrow.
Mm-hmm. Yeah. Love it.
Get there early.
Awesome. Good stuff. Thank you for joining us, Jacob. Getting some chats in our YouTube chat, loving the content, loving the 0-day stuff. I know a lot of people love the series that we've been doing on that. You also have brought a little bit of a sell-off in the market. E-mini S&P 500 futures down almost 40 points now. NASDAQ down 112. We're at the lows of the day. Everybody's wondering if maybe we've got a 0-day opportunity coming with a little bit of a pop in volatility here. Maybe those iron flies will be juicier going into tomorrow. We'll see if that's the case. We're going to take a quick little 90-second break, come back. We'll bring Scott on for live from the Tasty Trade Desk. We're also going to be taking calls for the rest of the morning here. 855-238-2789 or 855-BE-TASTY. Whatever you got questions on, or if you just want to talk about what's for lunch, which we haven't mentioned yet today, you can call in and give us some suggestions. So we're going to take a quick little 90-second break. You're listening to Tasty Live.